Welcome back to Alpha Recap. Today we walked through a market day that felt a bit split. Corporate winners and deal activity on one hand, and consumer caution on the other. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to unpack from the close. Earnings, M&A, and some macro numbers that made people pause.
Let's start with the opening tone. Markets opened with a risk-on tilt. ETFs and futures were bid in the pre-open, with the S&P roughly up about 0.5% in pre-market quotes. But that optimism ran up against a pretty stark macro data point.
Right. The consumer sentiment reading plunged to a fresh record low in May, and analysts linked that to inflation worries and geopolitical risk tied to the US-Iran war. That really set a cautionary backdrop, even as some companies reported impressive results.
What really stands out here is the split between company-level momentum and consumer-level caution.
Yeah, on one side, you had pockets of strength, especially among companies with clear AI exposure or corporate actions that created valuation anchors. On the other, record low sentiment suggested consumers were tightening up.
Let's hit the consumer and energy link first. Several retail reports pointed to a simple chain. Higher gasoline prices bite into disposable income and change shopping behavior.
Exactly. Warehouse club sales are a good real-time read. For example,
BJ's reported comparable club sales up 6.3% in the first quarter.
that number matters because club comps map directly to traffic and basket size. Warehouse formats are especially sensitive to pump prices. When gasoline takes a bigger slice of the weekly budget, shoppers cut trips or shift to essentials.
Memorial Day markdowns and anecdotal surveys showed people were reluctant to buy big-ticket items while fuel costs stayed elevated. That matched the low sentiment reading we mentioned.
Right. A drop in pump prices tends to free up discretionary spend into categories like seasonal goods or larger appliance purchases. But sustained high fuel keeps a lid on spending.
Switching to tech. This was an AI and compute day for sure. Lenovo had a blowout quarter.
Honestly, I was a bit surprised by this one. Lenovo reported about $21.6 billion in revenue, up about 27% year over year, and AI-related sales nearly doubled.
That's a huge beat, and it fed into the larger narrative that companies with tangible AI exposure are capturing disproportionate investor attention.
But there was also the debate, how much of that is sustainable? Is it recurring revenue or a temporary AI cycle? Hardware historically can be lumpy.
And then there was renewed chatter about IBM and long-term bets like commercialized quantum. Analysts flagged those as long-horizon stories that hinge on commercialization timelines.
Right. Some analysts think the thesis is compelling over many years. Others caution it's speculative until you see durable revenue and margin expansion tied to those technologies.
Okay, major topic transition. Deal activity. Deals actually provided concrete near-term anchors today.
Yep. InPost landed a FedEx-led buyout offer for about $9 billion, and they disclosed a tender window running from May 26th through July 27th.
The filing showed large disclosed stakes of about 61% and about 27%, which gives minority holders a clearer timeline to evaluate value and acceptance risk.
And then there was the REIT mega merger. The proposed combination of two big landlords would create a platform with more than 180,000 units and roughly $69 billion of scale.
That concentration shifts competitive dynamics. Think operating synergies and potentially lower financing costs, but also more regulatory and local market scrutiny.
Exactly. For income-focused investors, that matters because scale can support payouts, but it can also increase exposure to occupancy swings or rent cover dynamics in certain metros.
Quick reactions.
Right. Yeah, that tracks.
Let's explain a somewhat technical point in plain language, the bond holding time formula that analysts were talking about.
Sure. Think of it as a way to answer, how long would I need to hold a bond to offset the price drops that happen if yields go up? It's a mechanical tool to manage duration risk, basically giving advisors an explicit time horizon to hang on to a bond so the income cushions the mark-to-market losses from rising rates.
So it's not magic, but it helps put numbers around rate risk management. Good for people thinking about fixed income allocations amid sticky inflation and hawkish central banks.
Yep, it was one of the practical topics that popped up amid the earnings and deal noise.
Now, the market had some meaningful disagreements today. Let's run through the cleavages.
First, retail micro versus macro. BJ's comps showed strength, but some retailers like Buckle had only modest margin improvement, which some analysts said wasn't enough to re-rate the stock. So analysts split on whether company-level moves overcome the broader gas and inflation story.
Second, AI sustainability versus one-off rebounds. Lenovo's surge thrilled investors, but some question durability, whether AI rev is recurring and margin accretive or just a cycle spike.
Third, earnings momentum versus macro risk. Earnings season leaned positive, and futures were bid early, but the record low sentiment reading and geopolitical noise argued for caution. So it was essentially a tug of war between internals and macro.
Let's bring this home for different investor types. Briefly, no recommendations, just what analysts were noting.
Income and conservative investors. The holding time discussion was relevant. For REIT holders, the proposed REIT merger raised concentration questions. Growth and tech investors. Lenovo and IBM stayed on the radar. Watch guidance and revenue composition. Value and retail investors. Club comps suggested selective strength, but low sentiment and gas dynamics were red flags. Event-driven players. In-post tender and the REIT deal created discrete calendars to watch.
Tactical notes analysts flagged. Monitor gasoline price moves closely. Separate transient AI upside from durable secular revenue by tracking recurring revenue and margins. And use event calendars to manage position risk.
Yeah, and for fixed income, explicit duration management tools were being discussed as one input to limit rate-driven drawdowns, especially if inflation expectations stay elevated.
Bottom line, company-level winners in AI, select hardware, and event-driven M&A could outperform even as macro signals flagged caution. Analysts broadly agreed that gas prices and geopolitical risk were central to the consumer outlook, but they diverged on AI durability and whether firm-level margin moves would change valuation trajectories.
To be clear, this conversation presented analysis and data for informational purposes only. It did not constitute investment advice or a recommendation to buy, sell, or hold any security. Analysts' note and data suggest trends, but they do not replace personalized financial advice.
Key takeaways. 1. Watch gasoline and consumer sentiment readings. Those are high leverage for retail. 2. Separate AI hype from recurring revenue by checking margins, CapEx, and guidance. 3. Use event calendars. InPost and the REIT merger created clear timelines. And 4. Consider duration tools as part of fixed income risk management.
Yeah, when you step back and look at this, the market was digesting very concrete company-level news against a shaky macro backdrop. That dynamic will probably keep headlines busy into the next reporting and data windows.
Final quick reactions.
Right.
Thanks for joining, and thanks for listening. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. See you next time on Alpha Recap.